We recapped net working capital. We just spoke about it. What is net working capital? The difference between your current assets and your current liabilities. Okay, because I have those two, I have working capital. And remember, working capital is what is being used as part of your company's operations. Okay, that's the focus. Okay. We need to know what long-term and short-term is, because here we're going to be looking at an aggressive and a conservative strategy. Okay, so what are you comfortable with? Okay, are you comfortable to seek finance when you need it? Okay, or do you want to have finance available throughout the year? Okay, as and when you require it, you can tap that fund, okay, to access the cash. Okay. Then the last bit is obviously this, meeting obligations. That's the risk. Okay, the biggest risk that companies have is, can they or can't they meet the obligations? Right, you don't want to be in a situation where obligations can't be met, because that creates all sorts of problems. Okay, legal problems as well, and obviously difficulty in getting more capital. Okay, if you've got problems meeting obligations, okay, you're not going to be able to access as much capital as a company that doesn't have that same situation. Okay. Alright, so study unit 4, I've given you the learning outcomes here. Okay, this is a section that's tested often. Okay, so the cash conversion cycle, CCC, okay, you'll often see questions focusing on it. They'll talk about the cycle, how do we lengthen and shorten it. They'll talk about measures in terms of how do we calculate certain, let's say, values that give us information about the company. Okay, so make sure you can interpret the workings and also calculate the different ratios. Okay, ratio is probably the best way to refer to it. Okay. Then we've got a note about strategy. All right, there's two. There's aggressive and conservative. Okay, so you do need to know what the difference is, and you do need to know how to apply an aggressive and a conservative strategy. Okay, sometimes they do give you longer questions, okay, where they actually take you through the entire process. Okay, a change in assets, a change in bad debt, and so on. Okay, and you do need to draw up quite a long working to get to the final answer. Okay. All right, so to start off, how do companies generate profit? There's a clue. So, selling stock or offering a service. Okay, so goods or services. Right, and in today's world, the focus is on both, actually. Okay, goods now are viewed in terms of the service attached with those goods. Okay, so where do you buy your goods? Okay, it's a little bit of loyalty. Okay, because if I'm looking at purchasing goods, okay, if I know, let's talk about other big companies, Amazon. Okay, they're massive, right? Okay, so if I'm looking at Amazon, what is Amazon focusing on? Goods. But it's because their service is so good, people are willing to use Amazon to buy and sell certain products. Okay, so that's goods and services, right? You can be selling goods, but the service attached to those goods are also very, very, it's an important factor. Okay, so you can have a brilliant product. So let's say Apple. Apple creates brilliant products, right? Okay, but it's because of their service as well that creates the brand. Okay, because if you didn't have all these nice stores around, and if you didn't have all the support, okay, the product might not have such a good reputation. Okay, because who wants a good product if you can't get service? Okay, if something happens to the phone or if you need some help, then what do? Okay, you need that after-sales support. Okay, so that's just one example. Generating profit, it's good and service. Okay, it's both. Right, so what is the general cash process? We spoke about it. Okay, cash. Where does cash come from? Debt to equity. Okay, so we either get it from loans or we source it privately, okay, from our own, let's say, savings or investments. Okay, so cash is what we're looking at there, and we're trying to convert it into something else, okay, and back into something else. Right, and why? Why do companies want the cash conversion cycle? So why do you want to? So we just spoke about cash. Cash is valuable to the business because cash is a liquid asset that companies can use to do certain things with, right? So why would a company ever want to change cash into anything other than cash? Okay, growth in the form of value or wealth for everyone, shareholders, consumers, everyone. Yes, the only reason why companies would be willing to take the risk, okay, remember it's a risk. If I convert cash into anything other than cash, I'm creating more risk. And why would companies ever want to create more risk? It's to generate more return or value for shareholders. All right, so the risk that companies are taking is, I'm going to take cash and I'm going to buy stock with it. Okay? Let's say stock A, whatever A is. Okay? Is that a risk? Yes. Not everyone wants to buy product A. Not everyone wants that particular asset, okay, or product item. Okay, so that's a risk. By investing cash into that particular item, that carries a risk. But what happens in terms of the customers that do want the product? They buy the product and they buy the product at a markup. Okay, there's a margin that's added to that particular product. Okay, so companies take cash and they convert it into something else, either a product. So you'll take cash to generate a product or a service, and hopefully that product or service would be sold to consumers that would demand that particular asset, okay, and that would then create value. Right, value for the consumer and value for the business, because now the business's risk has been rewarded because inventory has now been sold at a markup or a margin that generates profit over the long term. Okay, and obviously, if we keep converting this over and over again, what do we get? We get a sustainable business and we end up being profitable, correct? Okay, so companies that are successful, think about Amazon. Why is Amazon so successful? It's not because they're selling one item, okay? It's because they're selling millions of items and they're selling it so quickly. Okay, why do you think Google is successful? Same thing, users, people that use the product. Okay, it's use. Amazon, use. Yeah, it's use. It's value. They're taking cash and they're putting it into R&D so we can get these fancy search engines that can do all sorts of things. Okay. It's everything, yes. It's become part of daily life. Right. It's because they took the risk, okay, of investing cash into something that was of value to consumers, and they've now sped up the process, okay, where they can then create other things as well. Okay, so in the crash course we spoke about a cash cow. Okay, do you remember what that is? Okay, so what is a cash cow? Okay, what is a cow? A cow is an animal that you milk for milk. Okay, so if you take care of the cow, what happens? You've got milk forever. If you harm the cow, you're not going to have milk. Okay, so a cash cow is exactly that. It's the cash conversion cycle in action. Okay, right. Cash cows. Cash cows generate cash. Okay, so the cow needs to be fed. Okay, but the cow will generate milk. All right, so the better care, if you care for the animal's going to survive. Right, and then you'll get other calves. Okay, I think, yeah, it's a small cow's a calf, right? It sounds like an agriculture lecture. Okay, but yeah. All right, so if we're looking at a cash cow, companies like MTN, companies like Vodacom, companies that are in the service business, okay, we all use our cell phones daily. Okay, those are cash cows. Okay, even SAB, right, that's a cash cow. People are buying beverages. Okay, those are businesses that are never going to go bankrupt because there's always cash. That's key. It's businesses that don't have this that struggle. Okay, so we need to look at businesses that manage cash better. Okay, so yeah, Twitter might be a bad company now, but hopefully in the future, you never know. Okay, I mean, look at Facebook. And compared to, yeah, but Facebook management is obviously a lot better, yeah. Okay. Google or Facebook? Google would definitely be worth more. Yeah. In terms, okay, that's a good question. So what is the most valuable brand in the world in 2016, according to I think it was Fortune or Reuters, one of the two. Which is the world's most valuable brand? Anyone know? It's still Apple, yeah. Okay, Apple's number one. No, Apple's still number one, yeah. You can check it, yeah. I think you might be talking about Coca-Cola. Coca-Cola has been the valuable brand for like centuries, but Apple has obviously overtaken them. Okay. All right, something else to consider. You guys are probably going to be able to answer this quite easily. Are all companies created equal? No. Okay, what can be different? Facebook and Twitter is just one example. Correct. Financing. Right. Not all companies want to raise capital in the debt market. Some might rather prefer equity. Okay, that also adds to your competitiveness. Okay, so you might have the exact same business. You might even have the same business model, right? But your business uses more debt than equity. Which business is going to be more successful? The one with debt rather than equity, because they're more aggressive. Okay, so financing is key. Not all companies are the same. Products are also different. Okay. Operations are also different. Okay, you don't all have the same people working in two competitive companies. Okay, so company A and company B, okay, they're always going to have different individuals. Okay, the operations will always be different. There'll be different systems. Okay, the systems might be similar, but they're still different. Okay, right, and then what determines the time or duration? Correct. Okay, so the time that it takes to pay your creditors. So how long is that process? How long, okay, do you have, okay, in terms of buying stock and paying it off? Okay, and then obviously debtors, same thing there. Okay, if you're giving debtors goods today and asking them to pay later, how long is that specific process? All right, so this is how we calculate the CCC, okay, cash conversion cycle. Right, the cash conversion cycle has three components. Okay, the first is looking at this, operating cycle. Okay, think about this in terms of operations, operating. So if I'm operating, what do I need to do? I need to buy and sell stock. Okay, so the stock is the average age of inventory. Okay, that's the OC. Okay, so this part of the equation is expanded. Okay, and that's why I said the CCC has three components. Okay, because the three components are actually, if I had to highlight them here, the three components would be this, the inventory, average age of inventory, this, the average collection period, and the final factor, which is the average payment period. Okay, those are the three components that make up the cash conversion cycle. Okay, because the operating cycle can be split into those two components. Okay, so those are the three key components that you would need in order to work out the cash conversion cycle. Right, so if I'm looking at cash, okay, and I'm looking at how soon, okay, does a company, let's say, realize cash, okay, convert cash into a product into cash again, okay. Operating, what is this? This is internal, okay, and then you've got the average payment period, which is external. Right, you don't have too much say here in terms of when you must pay your creditors. Okay, they normally set the requirements, okay, and you would then maybe negotiate and then eventually conclude, but this you can determine. Okay, you set your own collection policy. Okay, you know when creditors have to pay and so on. Okay, and average age of inventory. Right, stock. Okay, how long are we going to be holding stock for? Right, again, it depends on the type of business. All right, so to put that all on a diagram, just to show you what this means, okay, I've given you a note here about the total cycle. Okay, CCC. Okay, if I buy goods, all right, it takes 70 days in terms of the average age of inventory before I sell it. Okay, once I've sold the goods, okay, it takes 40 days on average to collect it. All right, so what would the operating cycle be? 70 minus 40? 110, 70 plus 40. Okay, because remember, this is what's happening internal. Okay, so diagram number 1 is focusing on internal. Okay, what are you doing in your business? Okay, in our business, the stock that we've got, that we're selling, okay, and that could be anything. It could be fast-moving consumer goods. It could be more bigger, expensive items, right? It doesn't matter. But on average, it takes 70 days to eventually sell it, okay? And it takes on average 40 days to collect after having sold it. Okay, remember this is credit, okay? Cash conversion cycle. We're converting cash into other and back into cash, right? And then later, we pay, okay? How long does it take us to pay? Well, when buying the stock. Okay, remember, if I buy the stock, I need to pay it off. Okay, so if I buy here, when must I pay? I need to pay after 30 days. Okay, so that's the credit policy you have with the supplier. Okay, after 30 days, on average, you have to pay. Okay, so that's when I pay. Right, so here's the outflow. There's the inflow. Okay, so we're looking at the cash conversion cycle, which is the difference, which is that part. Okay, so what I've highlighted in bold, okay, that bit over there, okay, that's the cash conversion cycle. Right, and how much would the cash conversion cycle be? Exactly, good. Okay, 110 minus 30 gives you the 80 days. Okay, so what does that mean? That means, on average, cash is converted every 180 days. Right, there's an 80-day conversion cycle for cash. Okay, so that diagram, remember we want the diagram to be quick. The faster the diagram, the better. Okay, this is 80 days for this particular company. Obviously, different industries will have different cash conversion cycles. Right, so you need to look at, well, if you've got an 80-day cash conversion cycle, what does your competitor have? Okay, is your competitor's cash conversion cycle more superior? Okay, are they doing things better? Right, are there ways that we can reduce this? The 70 days. Okay, maybe 70 days is too long. Maybe we should consider marketing. Or what about doing online sales? Okay, so coming in today, I don't know if you guys also heard, there was an advert about Springbok Pharmacy on the radio. And what are they doing? They're offering free delivery of any items that are bought from their online store. Okay, why do you think they're doing that? It's to try reduce maybe this, the average age of inventory. Okay, you don't want to hold medication on your shelf for too long, right? Okay, so they want to try sell stock quicker. And the quickest way to increase the sales is to let more people have the opportunity to buy. Okay, so now if you go onto that website, right, and you buy anything, as long as you're in the Vaal area or in Gauteng, right, Springbok Pharmacy will deliver the goods free of charge. Okay, right to your doorstep. Okay, and what is that? That is average age of inventory, trying to reduce it. Okay, and maybe also in terms of the collection, perhaps. Okay, maybe it could maybe have an influence or effect on their collections. Right, perhaps. Okay. All right, so that's the theory in terms of CCC. Okay, a little bit more theory that's looking at the funding. All right, so now we know what the cycle looks like. Okay, we need to buy stock, we need to pay it off, and we need to collect. Okay, 3 key things that relate to cash flow. Okay, if I'm looking at the funding requirements, funding is looking at raising capital, right? Okay, so having sufficient funds on hand to meet the requirements of CCC. CCC is looking at what? The operational side of things. Okay, so what can we do now from a decision-making point of view? Okay, remember, the financial manager, the FM, is going to have to make a decision to help support this, which is the operations. Okay, operations can't function without finance. Okay, so what do we need to do to help the cash conversion cycle? Well, there's two ways of sourcing the finance. Okay, permanent versus seasonal. Right, so if sales are constant, permanent funding is needed. Okay, if sales fluctuate, seasonal funding is needed. Okay, so that's looking at the 12 months. Okay, at what points in time do you have seasonal requirements, maybe spiking, going up, and also maybe going down? Right, maybe at certain points in the year. Okay, so if we talk about an ice cream business, okay, it's winter now, so the ice cream business in winter probably won't have as much sales. Okay, so their seasonal funding requirements in winter would be lower than their seasonal funding requirements in summer. Okay, because in summer they're going to need more funding to maybe keep the ice cream frozen. Okay, they might need more funding to buy more stock. Okay, they might need more funding to employ more staff. It all depends. Okay, but that's what we're looking at. We're looking at sales. Okay, and why do we look at sales? We focused about the importance not so long ago. Why is sales so important? It was also spoken in Fin 3701. Why is sales so important?
Without sales, where are you going?
Exactly. Okay, it's the first line on the income statement, right? So the first line of the income statement determines everything else, right? So if there are no sales, okay, the business actually collapses, basically. Okay, so the most important line item is the sales figure. Okay, so how do we keep the sales going, i.e., how do we keep the cycle flowing, okay, without any, let's say, hassle or problems? It's by considering this, permanent or seasonal. Okay, all right, so they spoke about an example in the textbook, okay, and the textbook gave you a business, okay, that had seasonal and permanent funding. Okay, so just to put a note here, okay, about that particular example, you'll see they talk about time. So time is on the x-axis, okay, and then you've got the funding requirements on the y-axis, funding. Okay, sometimes it could be given as a diagram, sometimes it'll be given as a list of values. Okay, then they'll talk about months, like month 1, 2, 3, 4, January, February, March, okay, and they'll talk about funding. Okay, what they will always give you is the permanent. Okay, so if I redraw the diagram that you've got in the textbook, okay, the new textbook would be, now I'm using Tanya's today actually. I've left mine at home. Yeah, this is on page 572. It's the short term. Yeah, in the old textbook. This is working capital and current asset management. So may I just make a note. This is in the working capital. I'll have it next week. I just forgot today. Working capital and capital asset management. Capital asset management. Okay, it's in that chapter. All right, so if you just refer to that chapter, you should see it. Okay, working capital, capital asset management. Okay, it might even be close to 572. Okay, in the new textbook. All right, so we were talking about the graph. Okay, so the graph will have funding, okay, and time. Right, do you agree during the course of the year, there's always going to be a minimum that needs to be met, okay, in terms of funding. There's always going to be a minimum. Right, and then during the year, your funding requirement could increase, okay, decrease, increase, decrease, depending on the situation. Okay, so your funding won't be, let's say, fixed. Okay, a certain amount you have to have. Okay, and what would permanent funding be used for? Not the day-to-day. The fixed costs. Okay, more for the fixed costs. So, for example, things like rent, things like staff costs, wages, salaries, and so on, right? Those are seen as more permanent, okay, because those aren't going to be changing over a 12-month period. Okay, they might be reviewed every year, perhaps. Okay, so maybe every year you'll then review the contract in terms of your rent agreement, or your staff might get an increase or decrease, or whatever the case might be. Okay, right, so that's something to consider. Seasonal is looking at more your variable cost. Okay, if I relate it to something you're familiar with from previous modules. Okay, seasonal is, well, in certain times of the year, I might need more stock. Right, in certain times of the year, I might need to employ more people. Okay, and that creates a difference between your permanent and your seasonal. Right, the difference would be the addition that you require. Okay. Alright, so how do we then cope with that scenario? There's two ways of solving that problem. Okay, so we know sales are going to increase and decrease over time. Okay, so if I'm looking at strategy, we've got conservative and we've got aggressive. Okay, those are the two different methods that we could use to solve this problem in terms of seasonal versus permanent. Okay, how do we meet those requirements? Okay, so if you're aggressive, okay, I'm going to use short-term debt when I need short-term debt, i.e. seasonal. Okay, so if in 1 month I'm going to need more cash, okay, to buy more goods or to pay more staff, okay, what am I going to do? I'm going to rely on short-term debt. Okay, so I'll access the revolving credit facility. I'll access the overdraft. I'll access the credit line. Okay. If I'm looking at permanent, I'm going to use long-term debt with permanent. Okay, if it's permanent, it's probably going to last for maybe 12 months. Okay, so if that's the case, I'm going to fund it with longer-term debt. Longer-term debt should be cheaper than shorter-term debt. Okay, because longer-term debt has a longer time frame, right? And normally, longer-term debt also has collateral. Okay, potentially. We'll discuss a few different ways of raising capital later on. It's a separate chapter. We're looking at the liabilities. Okay. Here we just look at the financing, the funding. Right, and then the other method is conservative. Okay, so if you're conservative, you're low risk. Okay, this is low risk. Right, so if you're looking at conservative, funding is going to be raised for both the seasonal and the permanent. Right, i.e. the total, everything that you require. Okay, because now it doesn't matter if I have more or less sales in a particular month, the cash is available as and when I require it. Okay, so if I've got cash that's sitting idle, what can you receive on that cash? You can receive interest. Okay, so that's always something that you need to consider when looking at the conservative, because you'll have surplus cash that will be invested. Okay, so you'll get a benefit from having cash sitting in the bank account. Okay. Again, the example in the textbook is very good. Okay, so please refer to page 573. Right, I think there was one in assignment 1. Okay, assignment 1 is only due in September. Okay, so I just want to get through a bit more theory before we look at it. Okay, we will look at it probably not next week, the week just after. Okay, the week before, I think the last week of August, we would have covered enough to complete the assignment without much difficulty. Okay, some of it you can do already. We've covered about half of it. Okay. All right, and then we've got strategies. Okay, turnover inventory as quickly as possible. Okay, why? Shortens what? The cycle, how so? The I, yes. Okay, and this is theory. So you'll see sometimes they give you different scenarios. It's normally multiple choice, and they'll talk about, let's say, different scenarios. So if the company does this, will this shorten or lengthen the cycle? Okay, then you need to choose the right option. Which option would, let's say, shorten the cycle? Or which option would lengthen the cycle? Okay, how do you approach a question like that? It's theory, but calculations help. Just write down the formula. Okay, if you write down the formula, you can then look at each component and then just think about it. If I turn over inventory quicker, what happens to AAI? It reduces. If AAI reduces, CCC reduces. Okay, that's how you would approach a theory question looking at this. Okay, or you can study it. You can go through some of the examples they give you in the textbook. Okay, the next bit, collect trade receivables as quickly as possible. Again, which variable does that affect? ACP. Right, if ACP decreases, cash conversion cycle decreases. Okay, you get cash quicker. Right, pay trade and other payables as slowly as possible. Again, there's theory. What variable does that affect? APP. If I make APP bigger, what happens to CCC? It should decrease, because the bigger this gets, all right, the bigger that gets, you minus. If you minus a bigger amount, you make the answer smaller. Do you agree? Okay, and that's how we approach it in terms of theory. Okay, relating the calculation to theory. Okay. All right, and then the last one here was better manage mail processing and clearing time. Okay, this is all the operations. This is the efficiency. Okay, because at the end of the day, certain things are within your control, certain things are outside of your control. Right, you would be able to manage the processing and clearing time. Okay, so maybe it takes too long to get stock into the factory. Okay, and those are things that you could consider, operational things that could help the cash conversion cycle. Right, because remember, if you're in a fast-moving consumer good type of environment. Okay, so have you ever gone to a store where there isn't stock on the shelf? You're saying no, you're saying yes.
What kind of, like a supermarket?
Yeah, retailer, a store. Often.
Well, like you've got to pick up mail or something, or go when they're having a sale.
Yeah, that's the exception.
Okay, so yeah, the exception would be maybe the sale. Okay, but if we're just talking generally, okay, they've generally got the stuff. Why? If they don't have the stuff on the shelf, what does that do to their cash conversion cycle? They lose out on a sale. So this average AAI would have gone up, okay, if there's no stock on the shelf. Okay, so that would have been affected negatively. The ACP, well, if people aren't buying, then there's nothing to collect, so that would be a null effect. Okay, this also would be a null effect. Okay, so the main reason would be that. Okay, the AAI, you're affecting your inventory. If the stock's sitting at the back of the shop and not in the front, that doesn't help. Okay, the stock needs to be on the shelf, right, for consumers to buy the stock. Okay, the shop or the store might even have stock in the actual store, but just not on the shelf, and that creates a problem. Okay, yeah, macro, big retailers, yeah. Okay, but yeah. Okay, guys, and that's today. That's today's focus. We looked at cash conversion cycle. Again, I do encourage you to look at some of the textbook examples. Okay, we've covered all the theory.